If you think silver's rally is just another commodities bull market, you're looking at the wrong chart. Silver didn't surge 144% in 2025 from $30 to over $70 per ounce because investors suddenly developed a newfound love for shiny metals. It's signaling a structural shift in the global monetary system, and almost no one is noticing it. While the S&P 500 ended 2025 inches, the red and most Americans were enjoying the good times in the economy. Silver was pricing in an uncomfortable truth that few wanted to face. When a traditionally volatile asset like silver outperforms gold by 66% and outperforms almost every other traditional investment, we're not seeing speculation. We're witnessing institutional fear. We're witnessing central banks, sophisticated investors, and even governments positioning themselves for a scenario most Americans can't imagine: the potential loss of dollar supremacy as the world's reserve currency. The truth is that silver isn't rising. The monetary system as we know it is in decline. And if you understand historical cycles after years of observing economic patterns, you know that moments like this aren't accidents. They're inevitable consequences of unsustainable policies that accumulate over decades. History is a relentless teacher, and it's shown us this movie before. In 1971, when Richard Nixon broke the Bretton Woods Agreement and disconnected the dollar from gold, many celebrated the flexibility this would give American monetary policy. What they didn't foresee was that this decision planted the seeds of every financial crisis we've experienced since then. During the 1,970 seconds, while politicians promised that the gold disconnect was temporary, silver skyrocketed from $1.40 to over $50 per ounce in January 1980. It wasn't the Hunt brothers' speculation that triggered that rally. It was the realization that a monetary system without a real anchor eventually collapses under the weight of its own contradictions. The pattern repeats almost mathematically. Every time a dominant empire abuses its reserve currency, precious metals start signaling the problem long before politicians acknowledge one exists. In the Roman Empire, when they began reducing silver content in coins, the wisest merchants were already hoarding the old coins. In Weimar Germany, those who had the foresight to exchange marks for gold in 1921 survived the hyperinflation that destroyed the German middle class. In recent Venezuela, even before the Bolivar's complete collapse, gold was already being used as a parallel currency. Now, in January 2026, we're seeing disturbingly similar signs. The difference is that this time the country in question isn't a peripheral economy. It's the United States, the issuer of the world's reserve currency. And when we witness geopolitical tensions escalating globally in different regions, this signals that arrangements based on economic consensus are giving way to demonstrations of force. Historically, this transition always precedes changes in the international monetary system. To understand what silver is truly telling us, you need to grasp three fundamental principles that govern all monetary systems throughout history. There's no free lunch in economics, no matter how much politicians like to pretend there is. When a country consistently spends more than it collects, as the United States has done for decades, that difference must be financed somehow. In 2025, the American fiscal deficit was $1.8 trillion, representing 5.9% of GDP. To put this in perspective, this percentage has only been exceeded during world wars, the Great Depression, and the 2020 to 2021 pandemic. Public debt now represents 99.8% of GDP, and projections indicate it will reach 106% by 2027. This means that soon the United States will owe more money than it produces in an entire year. When you understand that the American government spent over $970 billion just on debt interest in 2025, exceeding defense spending, you begin to understand why silver is rising. Markets are pricing in a reality that politicians cannot publicly admit. A currency only has value as long as people believe it will retain value in the future. This confidence rests on three pillars: political stability, fiscal discipline, and institutional credibility. In 2025, we saw worrying cracks in all three pillars. The Federal Reserve cut rates 3 times, even with inflation still at 2.8%, well above the 2% target. Internal divisions at the Fed reached the point where 3 members voted against the cuts, something that hadn't happened since 2019. President Trump himself publicly questioned Fed independence, firing Governor Lisa Cook and threatening to replace Jerome Powell. When a country's monetary authority becomes a political issue, confidence in the currency inevitably suffers. Every debt cycle follows the same progression. First, debt is productive and generates real growth. Then it becomes less productive but still manageable. Finally, it becomes unproductive and unsustainable. The United States has clearly entered the third phase, where you need to borrow to pay interest on what you already owe. You're no longer investing in the future. You're merely postponing the inevitable adjustment. The math is relentless. If your debt grows faster than your economy for long enough, you eventually reach a point where you can't even pay the interest. That's why silver is rising. It's not rising against the dollar. The dollar is falling against silver. Let me tell you a story that perfectly illustrates what's happening now. Imagine a country called Hypothetica, which for decades was the world's dominant economic power. Hypothetica's currency, let's call it the hypo, was globally accepted as a store of value. For years, Hypothetica leveraged this privilege to spend far more than it collected. After all, when you can print the currency everyone wants, why worry about balanced budgets? At first, other countries were happy to accept hypos in exchange for their products. Hypothetica bought cars from Germany, electronics from Japan, textiles from China, all paid for with freshly printed hypos. But gradually, some wiser leaders began asking uncomfortable questions. Why are we sending our real products to Hypothetica in exchange for colored papers they print at no cost? What if they decide to print so many hypos that our reserves lose value? That's how the silent diversification began. First, some central banks started buying a bit more gold just to be safe. Then countries like China began quietly reducing their hypo reserves. In 2025, we saw data showing that India reduced its U.S. Treasury holdings by 6% while increasing its gold reserves by 5%. China has been the world's largest gold buyer for years. But silver is where the story gets interesting. Unlike gold, which is primarily a reserve asset, silver is simultaneously a precious metal and a crucial industrial input. It's essential for solar panels, electric vehicles, electronics, medical applications, and 5G technology. When China, one of the largest centers of the industrial silver chain, imposes export restrictions, as it did in 2025, it's effectively saying this resource is too strategic to sell for papers you print. Silver supply deficit has lasted 6 consecutive years. Industrial demand keeps growing while production remains stagnant. And now, with the United States officially designating silver as a critical mineral in 2025, even the American government admits this metal is vital to national security. Now, let's translate this to what really matters, how this affects you and your family. If you're a typical American with savings in dollars, retirement accounts invested in American stocks, and maybe a financed house, you're completely exposed to what I call reserve currency risk. This is the risk that your national currency loses its privileged status in the international monetary system. When this happens, and history shows it always happens, eventually the effects are devastating for the middle class. Let's look at 2025 numbers that made this situation clear. The American dollar fell 11% in the first half of 2025 against a basket of other currencies, the largest drop in over 50 years. Meanwhile, silver rose 144%. If you had $100,000 invested in the S&P 500 at the beginning of 2025, you ended the year with less money than you started. If you had the same amount invested in silver, you ended with more than $240,000. But don't be fooled into thinking this represents real gains. What really happened was that you preserved your purchasing power, while those who held dollars saw their purchasing power silently confiscated by monetary inflation. If you're planning to retire in the next 10 to 20 years, you need to understand the brutal math. With American debt growing faster than the economy and interest costs already exceeding defense spending, there are only three possible scenarios: dramatic spending cuts, which are politically unlikely, massive tax increases, which would be devastating for the middle class, or monetary inflation to dilute the real value of debt. The third scenario is most likely because it's politically easiest, but it means your saved dollars will be worth a fraction of what they're worth today. A typical retiree who has $500,000 in a 401k invested in index funds may discover that in real purchasing power terms, this amount is worth the equivalent of $200,000 or $300,000 of today's money. If you're a business owner, monetary instability will create unique challenges. Long-term contracts will become risky. Capital planning will become nearly impossible. You'll need to become a currency hedging expert just to operate your business. The smartest companies are already adapting. Tesla, Microsoft, and other large corporations already hold part of their reserves in Bitcoin and other alternative assets. They understood that keeping all reserves in dollars is a concentrated bet on the American monetary system, a bet that's becoming increasingly risky. The average person will feel this first in prices, not just official inflation and government numbers, but real inflation in essential products, food, energy, housing. All basic necessities will become progressively more expensive in dollars. At the same time, dollar wages will struggle to keep up, creating a silent compression of middle-class living standards. Based on the principles we've discussed and the historical patterns we've observed, here are practical guidelines for navigating this environment. Don't keep 100% of your reserves in a single currency, not even in your home country's currency. The rule I use is 25% in precious metals, physical gold and silver, 25% in strong currencies from countries with fiscal discipline like the Swiss franc and Norwegian krone, 25% in productive assets that generate real income like real estate and stocks of companies with pricing power, and 25% in emerging technologies that can function as stores of value like Bitcoin, for example. This diversification isn't about maximizing returns. It's about minimizing total loss risk. Nominal assets are denominated in dollars. Bank accounts, government bonds, most corporate bonds, real assets maintain value independent of currency, prime location real estate, stocks of companies with tangible assets, commodities, precious metals. When a currency loses value, nominal assets are destroyed. Real assets adapt. For example, if you own ExxonMobil shares, you own oil wells, refineries, and energy reserves assets that maintain value independent of currency. If you own 30-year treasury bonds at 3% interest, You own a promise to receive future dollars, a promise that may be worth much less in real purchasing power. In times of monetary instability, the ability to generate income independent of the traditional financial system becomes crucial. Develop skills that have value independent of currency. Create multiple income sources. Build business relationships that can function even in crisis scenarios. If you're a professional, consider geographically diversifying your clients. If you're a merchant, think about how your business would work in different monetary scenarios. Have cash money, yes, still important for short-term emergencies. Have physical precious metals you can access quickly. Have assets that can be converted to money in different currencies. Liquidity in just one form, even if it's the best form, is a vulnerability. During the 2008 financial crisis, even sophisticated investors discovered that liquid assets can become illiquid overnight. The changes we're seeing are not short-term cycles. They're secular changes that can last decades. Your financial decisions today will affect not only your retirement, but what you leave your children. Build portfolios that can survive multiple monetary regimes, a strategy that worked very well in the last 40 years of declining interest rates may be completely inadequate for the next 40 years. The best protection against monetary changes is understanding how they work. Read about the transition from the gold standard to Bretton Woods. Study the collapse of the Bretton Woods system in the 1,970 seconds. Analyze how other countries dealt with monetary crises. Historical knowledge is your best compass for navigating unknown territories. Silver's rally in 2025 wasn't an isolated event. It was the visible symptom of a historical transformation happening under our noses. When escalating geopolitical tensions, including recent demonstrations of military force in various regions, become necessary to maintain international arrangements, this indicates that systems based on economic consensus are being replaced by others based on military power. This is not sustainable. No empire in history has managed to maintain its reserve currency status through force for very long. The Soviet Union tried. It didn't work. The transition happening now is bigger than any election, bigger than any specific policy, bigger than any individual leader. It's the transition from the dollar-based monetary system to something new. We still don't know exactly what this something new will be. It could be a multipolar system with several reserve currencies. It could be a return to some kind of modified gold standard. It could be something completely new involving central bank digital currencies. What we know is that the transition has already begun. Silver is just warning us. The Chinese buying record gold is warning us. The dollar falling 11% in 6 months is warning us. The Fed being forced to choose between inflation and recession is warning us. The unsustainable math of American debt is warning us. The fact that silver lease rates jumped 30 times above normal during stress periods in 2025 is warning us. The only question is, are you paying attention? In my experience observing cycles over time, I've learned that the market always knows before politicians. The market knew the Bretton Woods system was unsustainable years before Nixon admitted it. The market knew the 2008 housing bubble was unsustainable years before the collapse. The market knew Europe would need QE years before the ECB acted. And now the market is telling us through silver's price that the international monetary system, as we know it, is not sustainable. The question isn't whether there will be change. The question is whether you'll be prepared when it happens. The next few years will be defining for anyone who has wealth to protect. Those who understand the signals and position themselves appropriately will pass through the transition, preserving and even increasing their real purchasing power. Those who ignore the warnings will discover too late that they blindly trusted a system that was coming to an end. The choice is yours. But remember, History doesn't forgive those who ignore its lessons. And silver, that humble metal most people don't even consider an investment, may be offering the most important lesson of our lives. The monetary system that sustained American prosperity for decades is changing. The only question is whether you'll change with it or be left behind. It's not a prediction. It's a logical consequence of forces already in motion. And if you observe carefully, you'll see that math never lies. Silver rose 144% in 2025, not because it became more valuable. It rose because what it's measured against, the American dollar, is losing credibility as a global store of value. And this is a trend that once started tends to accelerate until a new monetary order is established. History is being written now. Make sure you're on the right side of it. While the S&P 500 closed 2025 with losses, silver was quietly signaling something that the mainstream markets weren't ready to acknowledge. Silver didn't surge 144% simply because of market speculation or a sudden infatuation with shiny metals. No, this rise in silver's price reflects a deeper structural shift taking place in the global monetary system, one that few are seeing. As most Americans celebrated economic growth, silver's price rise told a different story, one of looming economic uncertainty that the majority were unwilling to confront. Silver, an asset known for its volatility, outperformed gold by 66% and dominated most other traditional investments. This isn't speculation, it's a sign of institutional fear. The biggest players, central banks, wealthy investors, and even governments are positioning themselves for a scenario that many Americans haven't yet come to terms with. We're witnessing a potential shift in the global monetary system, particularly the threat of losing the US dollar's status as the world's reserve currency. But here's the thing. Silver isn't just rising for the sake of rising. What's really happening is that the monetary system, as we've known it, is steadily declining. Anyone familiar with historical economic cycles knows that moments like this don't happen by accident. They are inevitable consequences of unsustainable economic policies that accumulate over the years. History is relentless in its teachings. And we've seen this pattern play out before. In 1971, when Richard Nixon made the decision to sever the US dollar from gold, many believed it was a necessary move that gave the US greater flexibility in its monetary policy. What they failed to realize was that this decision set in motion a series of events that ultimately led to the financial crises we've endured since then. During the 1,970 seconds, while politicians assured the public that the gold standard would be restored soon, silver's price skyrocketed from $1.40 to over $50 per ounce by January 1980. It wasn't speculation driven by the Hunt brothers that caused this surge in silver prices. It was a clear recognition that a monetary system without any tangible anchor like gold was bound to collapse under its own weight. It's a pattern that repeats itself time and time again. Whenever a dominant empire abuses the privilege of holding the world's reserve currency, precious metals start signaling trouble long before the political leaders admit that something is wrong. History is littered with examples of this pattern. In the Roman Empire, when the authorities reduced the silver content of coins, merchants who understood the implications began hoarding the older, more valuable coins. Similarly, in Weimar Germany, people who had the foresight to exchange marks for gold in 1921 survived the hyperinflation that decimated the German middle class. In more recent history, Venezuela's population used gold as a parallel currency long before the Bolivar completely collapsed. Now, we're seeing similarly worrying signs in the United States. What's different this time is that the nation in question isn't some peripheral economy. It's the United States, the issuer of the world's reserve currency. And with geopolitical tensions rising in different regions of the world, it's becoming evident that the old economic order based on consensus is giving way to one built on force. This shift historically signals an impending change in the global monetary system. To understand the implications of silver's rise, you need to grasp the fundamental principles that have always governed monetary systems throughout history. There's no such thing as a free lunch in economics, despite what politicians might want you to believe. When a country like the United States consistently spends more than it collects, the difference must be financed somehow. This is a fact that cannot be ignored. In 2025, the American fiscal deficit hit $1.8 trillion, representing 5.9% of GDP. To put it in perspective, this percentage has only been exceeded during world wars, the Great Depression, and the 2020 to 2021 pandemic. Public debt now stands at 99.8% of GDP. And projections suggest that by 2027, it will surpass 106%. This means that very soon, the U.S. will owe more money than it produces in an entire year. This is a significant point. In 2025, the American government spent over $970 billion just to pay interest on its debt, more than it spent on defense. When you understand this, you start to see why silver is rising. The markets are pricing in a reality that politicians refuse to acknowledge publicly. A currency's value is determined by one crucial factor: people's confidence that it will retain its value in the future. This confidence is based on three essential pillars: political stability, fiscal discipline, and institutional credibility. In 2025, cracks began to appear in all three of these pillars. The Federal Reserve made 3 interest rate cuts despite inflation still sitting at 2.8%, far above its 2% target. Internal divisions within the Fed became so pronounced that 3 members voted against the cuts, a situation that hadn't occurred since 2019. Even President Trump publicly questioned the Fed's independence, firing Governor Lisa Cook and threatening to replace Jerome Powell. When a country's central bank becomes a political battleground, the confidence in its currency inevitably begins to erode. The debt cycle always follows the same path. Initially, debt is productive, it drives real economic growth. Eventually, it becomes less productive but still manageable. But when the debt becomes unproductive and unsustainable, the system breaks down. The United States is now in the third phase, where borrowing is used just to pay the interest on existing debt. The country is no longer investing in its future. It is simply postponing the inevitable reckoning. The math is inescapable. If debt grows faster than the economy for long enough, you eventually reach a point where you cannot even afford the interest. This is why silver is rising. It's not rising against the dollar. Rather, the dollar is falling against silver. And as the dollar continues to lose value, silver's role as a store of wealth becomes even more important. Now, think about this. If you're an average American with savings in dollars, a 401k invested in U.S. stocks, or a home loan, you are exposed to the risk of reserve currency collapse. This is a risk that most people don't even recognize. History shows us that when a country loses its status as the issuer of the world's reserve currency, the effects on the middle class are devastating. The U.S. dollar fell 11% in the first half of 2025, the largest drop in over 50 years. Meanwhile, silver increased by 144%. If you had $100,000 invested in the S&P 500 at the start of 2025, you ended the year with less money. But if you had the same amount invested in silver, you'd have seen your investment grow to more than $240,000. However, don't mistake this as a real gain. What happened wasn't that silver became more valuable. Rather, you preserved your purchasing power while those holding dollars saw theirs eroded due to monetary inflation. If you're planning to retire in the next 10 to 20 years, you need to recognize this brutal reality. The U.S. government's debt is growing faster than the economy, and with interest costs already exceeding defense spending, the three likely scenarios are drastic spending cuts, which are politically unlikely, massive tax hikes, which would devastate the middle class, or monetary inflation, which dilutes the real value of debt. The third scenario is the most probable one because it's politically the easiest, but it also means that the dollars you've saved will be worth far less in the future. As a business owner, monetary instability creates unique challenges. Long-term contracts become risky. Capital planning becomes nearly impossible. The smartest companies are already adapting. Large corporations like Tesla and Microsoft hold a portion of their reserves in Bitcoin and other alternative assets. Recognizing that keeping all reserves in dollars is becoming an increasingly risky bet, the average person will feel this instability first in prices, food, energy, housing, basic necessities will become more expensive, while dollar wages will struggle to keep up. This will result in a silent compression of the middle class's living standards. To navigate this, you need to understand the principles that have shaped past financial systems. Don't keep 100% of your reserves in one currency, not even your home country's currency. My rule is to allocate 25% to precious metals like physical gold and silver, 25% to strong currencies from countries with fiscal discipline, 25% to productive assets like real estate and stocks, and 25% to emerging technologies that can function as stores of value, like Bitcoin. This isn't about maximizing returns, it's about minimizing risk. Real assets, such as prime location real estate and stocks in companies with tangible assets, retain their value regardless of currency fluctuations. On the other hand, nominal assets, bank accounts, government bonds are tied to the dollar and lose value when the currency weakens. In times of monetary instability, the ability to generate income independent of the traditional financial system becomes essential. Diversify your income streams, develop valuable skills, and build relationships that can withstand crises. And above all, remember that silver's rise isn't just a temporary blip, it's a warning. The changes we are witnessing are not cyclical. They are seismic and they'll last for decades. Your financial decisions today will shape your future and the future of the generations that follow. The transition from the dollar-based system to something new is already happening. History is unfolding now. Silver's rally is just a sign of the times. Be sure you're on the right side of it. Silver didn't rise 144% because it became more valuable. It rose because the dollar, the currency it's measured against, is losing credibility as the global store of value. This is a trend that, once it starts, tends to accelerate until a new monetary order takes shape. Will you be prepared for that change? Time will tell.